Okay, so let's go over some of these example problems. So for the first one, Corporation A declared dividends of $600,000 on January 1st. The record date for the dividends is January 31st, and the payment date is February 15th. Okay, and we'll talk about the retained earnings in a minute, but first let's just concentrate on these first couple of questions. Prepare the correct journal entry to show the declaration of dividends by the corporation. So again, we talked about the fact that there's three important dates with dividends, and that the two dates that matter for accounting purposes are the declaration date and the payment date. Okay, so this first question is talking about the declaration date. As soon as the dividend is declared, is the journal entry to show that we now owe that to the stockholders. Okay, so we're going to debit cash dividends for $600,000, and we're going to credit dividends payable for $600,000. Okay, so basically what we've done here, this part here is going to show in the debit side what's going to happen to retained earnings, and this here shows that this is a liability because we've declared it, so we now are going to owe that to the shareholders. Then the record date passes, which again is just to determine who's going to receive this, so who has what share of stock. So does everyone who owns stock have 10% of the stock? Did any stock change hands between January 1st and January 31st? Once that's all established, we move to February 15th when we actually pay this amount. And again, since we have a liability right here, it functions just like when we talked in last semester about current liabilities. We're going to do an entry to basically net out and get rid of this liability. So we're going to have a debit to dividends payable for $600,000. And then, obviously, since we're paying a cash dividend, the cash account is going to be credited for $600,000. Okay, so these entries here show what happens at the declaration and then later at the payment date. So as I talked about in class, I wanted to show you what this looks like and how it ends up rolling over and affecting the retained earnings. So this is just basically one line over here from the balance sheet. And remember, for corporations, there's two sections of the owner's equity part of the balance sheet. There's retained earnings and there's paid in capital. So for these purposes, we are just seeing half of, and this is very simplified, but we're just seeing half of the owner's equity section of the balance sheet. So what we see here is that the retained earnings account has a credit balance of $750,000. That means this year, or in a combination of the last few years, this is the amount of money we've made from operations that we haven't already paid out in dividends some other time. Okay, so like I said, this account over here, this debit to cash dividends here, this is a temporary account, and when we go to, remember, a temporary account means it's just going to only last for the current period, and then we're going to eventually close it out and transfer that over to a permanent account. Well, retained earnings is the permanent account that transfers to. So say at the end of the period, when I go to make that transfer, it would look like this. So you'd have debit to retained earnings for $600,000 and a credit to cash dividends for $600,000. Okay, so what that effectively does is it closes out the cash dividends account, so that zeroes out. And then since I have a credit balance over here, if I added a $600,000 debit to this account, like so, then my bottom line total when I combine these two would be a credit of 150,000, and so that's what would be left over at the end of the day or at the end of the year once this retained earnings had been hit with the cash dividend. Okay, so that's the effect, and you see from this account here, that's what ends up affecting retained earnings, because when you close that out, the effect of it gets transferred over to retained earnings. Okay, so we'll see another example of that in the next section, the stock dividend section. Okay, so let's move on down to that one. Corporation B declared a stock dividend of 20%. There are 500 shares of common stock available to sell or distribute, and the stock has a par value of $10 per share and is currently trading at $15 per share. So the fair market value is $15 per share. Okay, so the first order of business here is to determine how many shares we're actually going to give out to the stockholders and what the value of that is. So if I have 20% of 500,000, that's 100,000 shares. Okay, so if I have 100,000 shares, I want to see, if I sold that in the marketplace, how much cash would I be getting for that? So what's the cash value of the shares that I'm giving away? So I'll have essentially 100,000 times $15 per share. Okay, so if I just do that in Excel, times 15, and I get, I want to change that to money, 1,000,005. Okay, so 1,500,000 is the cash value of the shares that I'm distributing. So what that looks like, instead of cash dividends, we're going to show stock dividends of $1,500,000. Okay, and I just noticed that I actually left a 0 off of this over here. So even though we haven't gotten to this stage yet, I'm going to just add that 0 back so it makes sense when we get there. Okay, so that's the debit entry, the first portion of this entry. And then I'm going to have, remember this, since the stock that I'm distributing is worth more than the par value of it, it's going to function a lot like selling stock in the marketplace at above par value. And remember, when we did that, we had one account that showed just the par value of the stock, and then we had another account that showed additional paid-in capital. So this first account is going to be common stock dividends distributable and this is just going to show the par value of the stock, so it's just going to be 100,000 times $10 per share, or an even million. Okay, and as you can see, obviously there's a difference here. This entry is not balanced yet because we have a $500,000 value of the stock dividends that we have not reflected in this balancing side of this entry. So the final portion here is just going to be additional paid in capital common stock. Okay, and that will go for 500,000, and you see that these balance. And again, this is just as of the declaration date. So since all of this action is occurring just under the owner's equity section, this is not actually a liability account here, even though it's something that we owe. But since we owe it to ourselves and no assets are really changing ownership, we're essentially switching the category of assets from paid-in capital, or from retained earnings to paid-in capital. So this isn't actually a liability account, but it functions like one. Okay, so what that means is in our next entry, we're going to want to zero this account out like we would a liability account. and we'll show what that is. So at the payment date, we're going to show a debit entry to cancel this out. So that will be common stock dividends distributable for 1 million, and then a credit to common stock for 1 million. Okay, so this confuses some people because in this bottom entry, we're not looking at all at the amount that was the additional paid-in capital. But the reason that is because we've already totally accounted for that additional paid-in capital in this initial entry. Basically, in this entry, we just are showing exactly how much that stock was worth more than par value as of the date that we declared dividends. Okay, so we're capturing the difference between par value and market value as of that date. So we've already done that. We've captured it. And then, you know, in the company's hands, that stock is worth the par value. So when we switch it over, we're switching over basically this $1 million from retained earnings to paid-in capital, and we're doing it by this entry here. Okay, so basically the additional value of that stock changes hands as of the declaration date because we're not worried about the price fluctuating after that, and then the actual par value of the stock doesn't change hands really until the payment date happens. So I know it's a little bit confusing, but you know, if you just remember that the additional paid-in capital is taken care of with the first entry, and the par value portion is taken care of on the payment date. That's probably the easiest way to remember it. But again, this entry here, whoops, right there, that is what affects retained earnings. So it works just like this one up here did, where the entry that we're going to show to decrease retained earnings, the journal entry is going to look a lot like this one, except instead of cash dividends, we're going to show stock dividends. So we're going to show a debit to retained earnings for $1,500,000 and a credit to stock dividends for okay. So what this does, this credit here cancels out this, and again, this is at the end of the year whenever we're doing financial statements. But this is basically the closing entry that closes out this temporary stock dividends account and rolls that money or the effect of that entry into retained earnings. And again, if we came over here and debited retained earnings for $1,500,000, then our closing balance after we net these two together is going to be $8,500,000. Okay, so that's the effect through this portion of the journal entry on the balance sheet. So let's move on to Corporation C. Okay, and this is testing more. Do you know what happens with preferred shares and how to do the preference for preferred stockholders? So Corporation C declares a cash dividend of $100,000. There are currently 5,000 shares of preferred stock outstanding, and the preferred stock is 10% preferred stock with a par value of $100 per share. So what that means is for each of these shares of stock, each of these 5,000, okay, each of them has a par value of $100 per share, and if we declare dividends, we owe each share of stock 10% of that par value. Okay, so we are going to end up owing each share of stock $10, each share of preferred stock $10 if we're declaring dividends and if we have that much to pay out to them. So real easy calculation there. You're just going to determine, hey, I have 5,000 shares of stock. Each one is paying $10 per share. So in this cell, if I just take 5,000 times $10 per share, that leaves me with $50,000. So that's how much of this cash needs to go to the preferred stockholders. Okay, so at the end of the day, all you're doing is subtracting 50,000 from 100,000, and you're left with another 50,000 that is able to be paid out to common shareholders. Now see, I didn't ask you to do any journal entries here. I'm just asking you to basically do simple math and tell me what's left over, okay, after the preferred stockholders are paid. So pretty simple there. Okay, finally. And I say finally because these are basically the types of questions that I want you to know for the quiz and test purposes. I'm not going to put any calculations on there for earnings per share, or I'm not really going to test any ratios if I can help it. So these types of questions and familiarity with these principles is what I'm most interested in seeing for the quiz and midterm and final. Okay, so the last portion here, Corporation D has a fiscal year that is the same as the calendar year. So it goes January 1 to December 31st. We're going to assume the date is May 16th of 2013, and as of today we have discovered an error in the 2012 financial statements. So these 2012 financial statements are already widely issued and being used by investors, potential investors, whoever uses financial statements, internally, whatever. But we've determined that our depreciation expense was overstated by $50,000. Okay, so what that means is if we've overstated expenses, then we've understated net income, because we said there was $50,000 of expense that wasn't there. If you take away an expense, income goes up. Okay, so since the 2012 financial statements are already distributed and being used, my only choice is to go into this current year, as of January 1st, and adjust the beginning balance of retained earnings. Okay, so if we look over here, we're going to say as of January 1, retained earnings had a balance of $500,000. Okay, so what I'm going to do here is I'm going to debit accumulated depreciation for $50,000, and I'm going to credit retained earnings for $50,000. Okay, so what that does to my balance over here, I'm going to add another $50,000, and my new balance is going to be $550,000. Okay, so this would be my new January 1 balance. Original, right there. Okay, and this would be my adjustment. So pretty simple. Remember that the only accounts that you can adjust here are permanent accounts. So like I can't go in and get rid of the fact that I had recognized depreciation expense. What I do go in and change is the permanent account that is carried over year by year that was affected by that depreciation expense. So when you have depreciation expense, that goes into the accumulated depreciation account. That's the balancing entry for depreciation expense. So this is the account that carries over year to year. So that's what I need to adjust to show that that really shouldn't have gone in there to begin with. Okay, so that's it. If you have any other questions, go ahead and shoot me an email, give me a call. Otherwise, you should be ready for the quiz.